Have you ever wished you could make a meaningful charitable impact during your lifetime without sacrificing your income, your retirement security, or what you leave behind for your family? Many successful individuals assume they have to choose between philanthropy and family wealth. But that choice is often a false one. In fact, some of the most effective estate planning strategies allow you to support causes you care about today, receive significant tax advantages, maintain an income stream, and still preserve a legacy for future generations. One of the most powerful tools for accomplishing this is the Charitable Remainder Trust, often called a CRT. A CRT allows you to contribute appreciated assets such as stock, real estate, or even certain business interests into a trust. The trust can then sell those assets without triggering immediate capital gains taxes, reinvest the proceeds, and generate income for you or another beneficiary. You receive income during your lifetime or for a specified term. Then, when that term ends, the remaining assets pass to the charitable organizations you have chosen. This structure creates a unique combination of benefits. First, it can provide an immediate charitable income tax deduction based on the projected value of the future gift. Second, it can significantly reduce or defer capital gains taxes when appreciated assets are sold. Third, it can reduce the size of your taxable estate, helping minimize future estate tax exposure. And perhaps most importantly, it allows you to witness the impact of your generosity while you are still here to see it. There are two primary types of charitable remainder trusts. A charitable remainder annuity trust, or CRAT, pays a fixed amount every year. A charitable remainder unit trust, or CRUT, pays a percentage of the trust's value, recalculated annually. For some donors, the certainty of a fixed payment is attractive. For others, the flexibility and growth potential of a percentage-based payout may be a better fit. One of the biggest misconceptions about charitable planning is that giving more means leaving less to your family. But strategic planning can often accomplish both goals. Some families use trust income to fund life insurance strategies designed to replace or even exceed the value ultimately directed to charity. Others use charitable planning to reduce taxes, preserving more wealth overall for both family and philanthropic causes. Of course, charitable trusts are not right for everyone. They are irrevocable structures, meaning they require careful planning before implementation. Once assets are transferred into the trust, those decisions generally cannot be reversed. That is why every charitable strategy should begin with a clear understanding of your goals. What causes matter most to you? What level of income will you need throughout retirement? How do you want future generations to remember and continue your values? The most successful charitable plans are not built around taxes alone. They are built around purpose. When done thoughtfully, charitable planning becomes much more than an estate planning technique. It becomes a way to align your wealth with your values, create meaningful impact during your lifetime, and establish a legacy that extends well beyond financial assets. Because the ultimate goal is not simply to pass on wealth, it is to pass on meaning. And sometimes the most powerful legacy is not what you leave behind after you're gone. It's the impact you create while you're still here to see it.